And we're back. Welcome to the Evolution Real Estate Podcast, where we stay up with the ever-changing real estate market. My favorite Thursday that we do this. Good to see my friend Scott. We haven't seen each other in a little while now. We took, summer hits, spring hits, stuff happens. I've been busy, you've been busy, but we're back with not potentially great news, but not maybe bad news at the same point. So for those who haven't been here before, this is the whole idea of this is Scott and I used to meet and just talk about this stuff together, discuss it, and then we thought, okay, let's do a podcast on it. Then we thought, okay, let's do video with that, and then we thought, let's go live with it. So just like everything else, it evolved into what it is now. So now we try to do this live every other Thursday, just try and give some updates on the market. So without going too much more in the detail, my name's Justice. I am a mortgage loan officer, so my job is to help home buyers get a mortgage. And I'm joined by my ever good looking, straight shirt wearing friend, Scott. Give us your intro.
Oh no, you're gonna make me blush. Yeah. Thanks, Justice. My name is Scott Ebel. I'm with Greater Midwest Realty. I've been a broker for a few decades anyway. Been doing this a little while, and always enjoy really helping home buyers and sellers get into their next home. So yeah, that's who I am and kind of what I do, and excited to be here and share and take a look at what's going on in the Twin City market and just share with people as we progress through this summer market. So
Yeah, and the summer market's coming. So before we get into
yeah,
that, what have you been doing the last couple of weeks, and what do you got coming up?
yeah, just been pretty active with buyers listings, doing the use there and just kind of chugging along. It's been good. Definitely some changing times, and as we speak, really, I think the market's changing as we speak. And I'll kind of go through some of that. So other than, normal working with people, buyers and sellers, just actually been doing a lot of work on my own home. Been there for a number of years, and all those projects that stack up that you never got to and never did, and said, we'll do that later. Well, the time has come. It's a reckoning, and it's time for me to get that stuff done. And so I'm just finishing up sheetrocking and mudding and taping and finishing my garage, which a portion of it was done, but it was not all done. And so finishing that up for my daughter's graduation that we're going to have.
Okay.
And so there's always all these things that I said, you know what, now's the time and we're going to get it done. So been working hard on that pretty much every day, or as much as I can. And then looking forward to a Boundary Waters trip. Have you ever been to the
Ooh.
Boundary Waters at all? At all,
No,
Justice?
I have not. I'm assuming you're going up there for fishing, and I am not an outdoorsman. So
Yeah,
no,
so
I have not.
yeah, no, it actually really, really excited about this with some great friends. We went last year for our first year. It was our inaugural, and we're doing it again, so it must have been good. Anyway, we're going up towards Seagull Lake in the Boundary Waters, up to Gunflint. And for those, I know there may be some listeners or people watching that go up to the Boundary Waters and just love it. So, gonna keep doing it as long as we can, and we're still having fun. And hopefully the bugs. I know that the water's really high up there, and hopefully the mosquitoes. We're going to definitely bring mosquito net and DEET and all the other fun stuff to keep them away. So we got one guy that usually sings us to sleep, literally, because we bring guitars, and I know you're not supposed to. There's noise pollution. You got to kind of keep it down, but
Oh,
it's our own noise, and we kind of
acoustic.
try and be
Yeah.
secluded. But last year he serenaded us all to sleep with his bug net on. I wish I would have had a video of that. But anyway, I
Oh my.
digress. So
Oh my.
how about you? What have you been up to? What's been new with you? Anything
Yeah,
you can
summer.
share?
Yeah, summer's definitely hit. So in the summertime, I get really busy with my sports. So I try and play golf
Yeah.
in the early mornings before uh, work starts, so I can get that done. And in the evenings, I play a bunch of roller hockey. So I actually got a pick here from one of the teams I played on. We got a little fall, or I guess
Nice.
spring championship. So there's a crew here. Obviously, I'm the old guy on the team, but um, got a nice little crew there, roller hockey guys. I play way too much roller hockey, but don't tell my wife. But I absolutely love it. So,
Yeah.
and in the summer, that's when movies come out. I'm a huge movie guy, so I love going to the theater, eating 2 buckets of popcorn when I'm there. So, hitting that up.
Oh yeah.
So, sports, movies, and outdoor activities. My outdoor activities are more like sports, but yeah, plenty
Yeah.
plenty of activity in that realm.
Top Gun? You're gonna go see Top Gun, or did you
Already
already see
seen
it?
it. It was fantastic. I still have to see the
Oh,
first
you
one
already
though.
saw it?
I haven't seen the first one, so
Oh, huh?
I haven't seen the first one
You
yet.
didn't? You saw this one, but you didn't see the first one.
Yeah,
Oh boy.
I'll
Okay.
pretty much
You got to go
watch any
back and see
Tom
the
Cruise
first one.
movie. That's
Yeah.
what I hear.
So,
That's what I
so
hear.
what are we giving it? Are you giving it one thumb up, two thumbs up? What are you doing?
Oh,
What do you think?
it's a big
All
thumbs
the way?
up. Oh yeah,
All right.
it's fantastic.
Very cool.
And I'm sure
I
people who
haven't
have
seen
seen the
it yet,
first
so
one,
no spoiler alerts.
yeah, if you've seen the first one, I'm sure you'll love it. That's anyone I talked to, that's how they
Oh
felt
yeah.
about it. I loved the second one, and I had no idea what was going on, so my wife was filling me in like I do with her when we go to those Marvel movies.
Okay. Yeah, when did the first one come out? 1985 or 86 or something?
Well, I wasn't born yet, so that could be true. Yeah.
So no wonder you didn't see it.
Yeah. Yeah. Never got around to it. Yeah.
Yeah, I never got around to it. I'll get to it.
Yeah.
All
Yeah.
right.
Well, yeah. Let's
Good
uh let's
stuff.
let's dive in. Let's get that market update.
All right, let me go ahead and see if I can share my screen here.
Okay.
Let me know when you're able to see it, and we'll
Okay.
get started and take a look at should be there.
There it is.
All right. So what I always like to do, there's some leading indicators that I always like to take a look at. And right now, if you can see it, homes for sale through May, we've got information or up-to-date information through May of 2022. And right now, as you can see, this uptick in homes for sale. Currently, we're at 6895 on the 13 county metro area, according to InfoSparks, and that's the reference that I'm referring to or using today. Which year over year, that's a 6.8% increase from just a year ago. So as you can see, the trends and April, May, that's where we were at 64.56. So you can kind of see the trends, are pretty familiar, pretty similar, but we're kind of doing the same thing, but we're seeing getting into beyond a little bit beyond the spring market into the summer market now, as homes for sale are starting to come on and be presented. So in addition to that, I always like to look at closed sales. So I'm going to switch over and look at closed sales. And that usually follows pretty closely. And where we're at through May on closed sales is 54.72. Actually, year over year, that's a decrease from a year ago in 2021 of 3.3%. But nonetheless, people are still buying and still closing. And I think that may have something to do with the recent interest rate and some of those other things. So, but homes are still selling. There's no question at a pretty good clip as we move forward. The next one is months of supply that I always look at and try and watch this, because this is a pretty good gauge of what the market's going to do, right? Because if you don't have inventory out there, well, you can't sell or you can't buy homes. As you can see, we've been in a pretty stagnant or low inventory on the market, which has respectively driven the prices up, right? And so in May, however, now we do have an uptick on months of supply for quite some time. I mean, we were at 0.9, some of the unprecedented numbers that we've never seen. Even a year ago we were at 1, and when that was the first time ever that it hit one month of supply, meaning that and I've spoke to this before, is that if all the homes that were on the market were to sell, we'd have within 1 month we'd have no more inventory if as it were moving forward as it's depicted here now. So that's what months of supply is. So you always like to see a balanced market is closer to 5 months of supply, where it's equally negotiable for the buyer and the seller. So that's why you see for the last couple of years anyway that we've definitely been in a seller's market and home prices, along with low interest rates and ability to borrow money so cheaply, that's kind of driven some of the prices. But nonetheless, right now we're at 1.3 months of supply, and it seems to be raising or rising, which is a good thing, especially to balance out the market for some of the buyers out there that are looking to find their next home. New listings, as you can see, pretty traditional though after December. December 2577, that's kind of a low point. Obviously, it's the winter months. Not as many people want to move. Not as many people are putting their home on the market for sale. But as you can see, as we get into the spring and summer market, it starts to grow and grow and grow. So new listings, we're up to 7933 right now, and that is a plus side of 3.3%. So that's a kind of the bright spot in the market of having new listings. So that's kind of what's going on with our market. We'll talk more about maybe what we think is going to happen and where it's going to go, but hopefully that shares some, perspective with anybody that might be listening or checking in with us as far as what's going on right now through May anyway. I know we're just into June. So these numbers are all through May. So any questions, Justice, or anything you might have as far as regarding what the market's doing right now and inventory and what we're
Yes.
seeing?
So what do you expect with this increase? Like when we look at this, like we know it's a 3.3% increase. If this keeps
Yeah,
going up, what does that mean? Like let's just say, obviously we see the pattern and it's up and down, up and down. But what if for some
right.
reason this line goes up to the 10K line?
Yeah. Well, obviously that's going to be a huge indicator and a market indicator, because anytime you get new listings, and depending on how many sell, then you're back to looking at closed sales, right? And pending sales and some of the other things, as I referenced before, the closed sales. Typically in a market, they're going to follow somewhat, be aligned. But if it dramatically goes up and none of these homes are actually closed, we start to see a huge dip. Obviously, what is that going to say to the market or do to the market? That's why looking at these numbers and tracking these as they do through the MLS, it's vitally important to understand and kind of see where we've been and then potentially where we're going to go. But I mean, if it were to go up to when I go back to new listings, if it were to go up to 10,000 new listings and they didn't, they sat on the market, obviously that's going to have to do with a trend shift, and we'll talk more about that as far as potentially getting back or closer to a balanced market, which we have not been in for the last couple of years. As you can see, the inventory is just months of supply has been dramatically low. The highest point in the last couple of years back in June was 2.7, and that even in its own right is unprecedented. Very, very low. But where we've been in the last couple of years, I've never seen it in my career ever with
Hmm.
this little amount of homes. So it definitely would start to shift things in the favor of buyers, if that answers your question.
Yeah. Okay.
So with more inventory, more homes, it's for them to look at, to have an option to buy and be able to one thing, not to go off on a tangent, but one thing that you see with this low of an inventory is that we're kind of in that right now. We're dealing with this situation, but contingency of sellers finding the choice of their home of their choice definitely is that is somewhat of a newer animal, and people never really had to do that before, and we're seeing that and have seen that. So contingencies of seller able to find a home of their choice becomes a factor with low inventory. But as inventory rises, they have a better opportunity to find that next step up home or get into their next property. So it's a good thing, I think, for the market as we get more inventory, more possibilities of people putting their properties on the market. So yeah,
Interesting stuff.
yeah. So that's kind of where we're at. I will if no, we have no questions, I'm gonna stop sharing my screen. I'll give it back to you.
Okay.
Uh, let me know when you got it and we'll
Yep.
keep going here.
Okay. So yeah, I will touch on the rates. So as we know, the Fed is expected to raise rates next week about 0.5%. That's what's expected. What's been factored into the stock market. That's what's been factored in to the bond markets and everything with the rates and everything. So obviously that's expected. So if for whatever reason the Fed did a 0.75% increase, we all obviously know that's a higher jump than what was expected. Things will get a little crazy next week and jump quite a bit. We know it's not going to happen, but if the Fed, for whatever reason, did a quarter point, 0.25, the markets and everything would rally because then that would be a sign that the Fed thinks they're getting stuff under control, which we know just from listening to Powell, that's not exactly the case. So you and I talked off air on this about, the Fed kind of following a little bit of the Paul Volcker 80s stuff when inflation was at hyperinflation and things were way out of control. So we definitely don't want that, and they don't want that either. But back then, I don't know the exact details, but Volcker raised. What he did was he raised the rates above what the inflation points were. So right now, inflation's like at 8.9 or something like that, based on the CPI data
Okay.
from last time, and that would mean the Volckering would make it that Powell would put the interest rates at like 9 or 10%, because then it would just essentially just stop everything, because it wouldn't be worth anyone to do anything with how high the interest rates would be. So, with that in mind, if we're looking at, let's see, let me share this. Let's see. Oh, wrong screen. Let's see. Where is it? Share. Where's my website one? Here we go. No, it's not coming. All right. There we go. Waiting for that to click over. So, what we're looking at here is the 10-year Treasury bond. We can kind of see that it's jumped up, obviously, since it's a broken record, but it's jumped up quite a bit. We can see since December. The new year hit and things just started jumping. So we already know that. So let's zoom in into the month. And in the last month, we know that there was kind of like a small dip in here. This small dip brought interest rates, I'd say, a little bit more reasonable, where you could get a first-time home buyer rate, you know, 4.99, maybe 4.875 if you paid some points. But it got, general rates to 5.125, 5.25. But as this goes up, this is where you start seeing rates, get into the 5.5s, the 5.625s. We can see just simply in this week, the start of the week, things kind of been a little rocky, but overall, the overall trend is they're going up. We can see today, kind of again a little bit all over, but the general trend, if we look 3 months out, we know we're going up. If we go 6 months out, you can see we're near, peak stuff. Even a year out, we're again near peak. If we go back 5 years, this is where we kind of get to see where we were, back in 2018. And you can see we peaked out around, 3.23. So we like to say right now that the peak on this 10-year treasury is 3.25. If we see that 3.25 up in here, so you can see kind of how much gap space we have there, we'll probably see rates in the sixes. This is currently our ceiling for the current resistance lines. If we break above this, there is not a whole lot of knowledge about where it's going to stop, because you can see even from the last 5 years, nothing's really peaked above that. So if we break through that ceiling, I don't exactly know where it's going to stop. Now, predictions are currently we're going to get there, it's going to hover, it's going to bounce off of this, and we'll see kind of some more of this stuff going on, this kind of bouncing. Obviously not to this extreme, but we'll get to see some bouncing, kind of like we've seen. Let's see in this window how there's a little like valley to this bouncing. So right now, resistance line is around 3. We're bouncing off of it right now. And then if you can see kind of like see all these high rates on the bond markets. It's just below 3. If we break through significantly, so if you see this get to like 3.7, it's probably going to continue upward. We just had a current meeting, and that thing at the meeting they were saying like, yep, expect the bond market to get to 3.25 and expect rates to get to 6. They didn't give us exactly time frame, but I would not be surprised if we see that by August or September, which will coincide obviously with how the housing market is, because that's usually hot, and then it starts kind of fading down a little bit closer as we get past school, and then has a little jump in there, and then it starts to fade out a little bit as we get towards the holidays.
So, which is
yeah.
actually, isn't that higher than what was predicted at the beginning of the year? I know it's
Yeah,
only a
yeah,
prediction, but
yeah.
it's definitely
Beginning of
higher
the
than what
year,
was
yeah,
expected even to be, or what it should be.
yeah.
They
We're
thought
way
it.
so based. If you look at this chart, in December, in the middle of December, beginning of December, we were down. This bond market is like a 1.3, 1.5, and then we know 2022 happened, so it ended at 1.5, and then 2022 happened, and things started going up. Based on what we were supposed to end at this time in December, I was still quoting in the low threes for interest rates.
Yeah, yeah,
And we were predicted to be near 4 or like 4.25 by the end of the year. If you put
right.
that in perspective with this chart, we hit those predictions by February.
2 months later.
Yeah, not even, it was probably like end of January, early February. Yeah. So
Right. It
that's
wasn't
how
even. It was
quickly, yeah,
basically a little more than a month.
that's how quickly things changed. And so now, you can only take these predictions with a grain of salt. And I say that, and
Right.
one of the predictions is that we will be pushing into 2 to 3 years from now. Everything will be under control, and we'd be pushing back down to the threes for interest rates. So obviously, take those for a grain of salt.
Well, it's interesting to see, and I don't know if President Biden met with Powell this week or last week. I think it was last week, and had a sit down or kind of a intervention, if you would, and may have some political power or political incentive behind it, because obviously an incumbent trying to get reelected with inflation rates well beyond earning capacity is definitely an issue for any political
Mm-hmm.
incumbent. And so, was it this week or last week that they sat down, and I think President Biden had, kind of, nobody knows what was discussed, but one could presume that obviously let's start to get the inflation under control, and how do you do that? And I think, Paul, that's some of by raising interest rates and
Yep.
taking away that feeling of wealth or disposable income, if you would. I mean, you look at it over the last decade, even especially the last couple of years, but even the last decade, how artificially low our interest rates have been. It's just been phenomenal to be able to borrow as much money as you can at such a lesser, such a low rate.
Yeah, for sure.
So
Yeah, and
so I think
that's all with those
that
those mortgage-backed securities that the Fed was buying up. Essentially,
yeah,
mortgage-backed securities, think of that as a fancy word saying that all these, when you sell your home, it gets lumped together into like think of it as like a package, and then
yeah,
different companies buy those because they get the interest from them and all that kind of stuff. Well, the U.S. was
right.
buying those, just straight up buying those like crazy, and that was keeping
The
rates
feds
low.
were. Yep,
The Fed, yep, because then it was essentially buying those up, so then they could buy them up at the price they wanted to buy them at, and it kept everything, interest rates here. And then in
right,
March, uh, they announced before that they were going to stop, and they were going to do what's called tapering, so they're going to slowly buy less of them as time went on, and they said they'd be done by March. So just that announcement in itself made rates go like this. Oh, they're going to stop buying them, so now rates are going to come back. So
so
yeah,
so that's the justification of what we saw, or of some of the reasoning of what you just showed, that graph, and
mm-hmm.
why, because everybody wants to know why what
Yep.
it's like gas prices. Why did it go from a year ago, $2.89 or $2.84. And now you go to the pump and we're paying 4.50, 4.59.
And we
And,
thought it was high back then. Yeah.
yeah, I was like, oh, don't get to three, don't get to three,
Uh,
and now we're at, 4.5. And so,
and we're lucky because I just
interesting
saw a picture
times,
from
interesting times.
California. They hit 10 today.
Where,
$10.
where in California? Huh?
Mm-hmm. Yep.
Where was that?
California,
They hit gas prices for a gallon of unleaded gas.
$10.
Presumably it's northern Minnesota or northern California. They hit $10 today.
Yep.
Wow. Okay. All right
Yikes.
then.
Yikes, yikes, yikes.
So
And
there you
just to
go. There you go.
quickly touch on, just to finish up what I was talking about with the rates. So just to look at this
Yeah.
Freddie Mac chart, um, you know, let's zoom this back to, let's go, everyone likes to know from the beginning of the year to now. We can just see a beautiful chart to those who don't want to buy a house. Uh, this thing is going up, and even in this is that small little gap we talked about, right? But you can see the trend line is still, everything's going upward. Everything's
Yeah.
going up. So um, the biggest thing right now people are hitting up are these arm rates. So you can see on this chart the 5-year arm for Freddie Mac. This is, and what this does is it takes an average of like all sorts of servicers, lenders, all that kind of stuff, and this is, they accumulate these. But you can see even the 5-year arm is in the fours now. A 30-year fixed 5.23, and that's with a point. So looking at this, keep in mind that's showing with a point. So for those who don't know, a discount point is literally buying extra closing costs so you can get your rate lower. So you're buying a lower rate. Um, and if you buy a $300,000, if you have a $300,000 loan and you buy one discount point or 1%, that means you have additional closing costs of 3 grand. So that kind of stuff adds up. So if this was
Yeah.
5.23 with a point, that means without a point, you probably at 5.625. So it's heading up.
Which, in the grand scheme of it, and we've talked about this before, and 5% is still, historically, it's although, and right, we hindsight's 2020, but recently you look at the rates, what they have been, we just got spoiled, and we've talked about this
Mm-hmm.
of where the rates have been. So, if it, and there's always an opportunity later on for someone, if and when the rates do adjust or come down, you can always refinance. But I mean, if you can
Yep,
afford the payment, there's still great opportunity there,
for sure, for
to be
sure.
able
Yeah,
to get in, there's no
yep,
question. But
yeah. I
historically,
mean,
5.5% is not crazy, for a
right.
mortgage,
And the
correct?
the byproduct of these low rates, has been increased home prices, which was a byproduct of inflation, lumber prices, everything going up. So it all plays into each other. But right, yeah, 5.5. It's still historically a good rate. The issue is obviously home prices are just so much higher. So we know that
Right.
they've probably peaked, so they're probably coming down. It's just a matter of how much. People are hoping for some bubble or some crash. That's just not going to happen. The crash happened before because the way mortgages were put together. You could get what was called a ninja loan, and you could have a no income, no asset, and you could just state your income. And we all know how
Yep.
that went, and you can clearly see why that was probably a problem. So there's not those kind of programs anymore, so things are a lot more structured and safe. So if you're holding out for a bubble or a crash, it's not realistic.
I actually had one of those loans. It worked out for me, but
You had
I didn't.
you had a ninja loan. Oh,
I didn't
good.
default. It was fine. It was
Yep.
fine, but I actually had one of those. Um, yeah, it'll be interesting, whether or not I think there's a correction or there's an adjustment. There definitely
Hmm.
is. I mean, you look at the GDP and some of the numbers out there, that's a huge percentage of our expenditures. I mean, and so, yeah, just consumer confidence and where it's at and where we're going. And it, yeah, I think we're looking for an adjustment as we can kind of see. I don't know if I mentioned this earlier as far as the price reductions. Not sure that I quite touched on that earlier when I was sharing some of the numbers. But today alone, uh, I looked on the MLS and there was 127 price reductions today alone. Thursday and Friday are big listing days for properties to hit the market for the weekend. But to see 127, you know, that's more than we've seen. So you start to see price reductions that comes into play as well.
So
So
Scott, so what does that mean we're potentially switching from a seller's market to a buyer's market? And if so, and if not, what does that mean for the average consumer?
Well, it's anybody's guess, right? As I've said oftenly, I wish I had a crystal ball and I could tell the future, and I think a lot of people do. You just got to pay attention to the trends, pay attention to what the numbers are sharing or what they're saying, and just keep moving forward. But as far as when you start to see days on the market go up, that's a true indicator that hey, we're not having these bidding wars. Not to say that they're not happening, because if it's a right price or the right property and it's priced right, there are still a lot of home buyers that are looking and available for that purchase. So, um, you know, but I think those are the indicators that we got to kind of watch and see. It's still a very, very strong market. There's no question. There's a ton of activity going on all across the metro area. But as you start to see days on the market go up, potentially price reductions, those are all things that come into play where sellers have to really be accurate on their pricing and start to maybe be a little bit nicer to buyers for them to pull the trigger and move forward. So
Hmm.
um, I don't know if that answers your question. I don't, I think we've seen some things slow down a little bit as far as the feeding frenzy and, once you put a property on the market and you've got 80 showings and 30 offers, it's just that's what it's been. But
Yeah.
will it
Yep.
continue? We still see some of that, but I don't think to the scale that we may have in the past here. So
Mm-hmm. Mm-hmm. Yeah,
yeah,
and
so
I mean, there's only a few things I want to touch on. I got some notes here. So obviously we know after a
yeah,
record-breaking 2 years, stuff's bound to slow down. The market can't sustain that type of level of activity. So mortgage demand is at the lowest it's been in 22 years. The average
wow,
rate, which we kind of talked about already, but the average rate is up to 5.4%, according to Mortgage Bankers Association, which is with 20% down. This time last year, that rate would have been 3.15. Um, and then the upper boundaries, we talked about that when we talked about the 10-year Treasury. The upper boundaries of the interest rate will range depending on really the inflation and economic data coming in. So we know that CPI data is being released tomorrow morning. So we'll get to see kind of how that's being reflected if inflation will actually show that it's coming down. So far it hasn't come down yet. It's increased but hasn't increased as much. So that is considered a win, which means the Fed's actually doing something correct. So we'll see from this recent data coming up. Clearly, with rates being where they are, refinances are down 75% from what they were at this time last year. Actual mortgage applications are down 21% from last year, and home prices are actually up 21% nationally from a year ago, according to CoreLogic. So interesting stuff there. The other thing to add is that there are 46 million Americans that collectively owe $1.75 trillion in student loans, which is an average of
wow.
$40,000 per borrower. That is supposedly the payments are coming back supposedly September 1st. That will be a big shock, and I'm going to be wondering how the economy is going to respond to that because everyone's been so used to a certain type of living without these student loan payments and just kind of like letting them sit out there. Um, it's
Sure.
going to be interesting to see how that plays out.
Well, I think that's it. I mean, people have felt, there's been so much stimulus money and other things in the last couple of years with the pandemic, and now that's all come to an end. So we're not seeing that. There's still a few things out there, but not like there has been. And now with interest rates potentially gonna to go up, um, there's only one thing that can happen. The economy is definitely we'll see. I mean, it's definitely going to slow in some areas. If you look, I'm not an expert on bonds or investments, but I know that just some of the things I followed. You look at some of the bonds and stock market. Where is that? How much
Mm-hmm.
how much that's been down lately. So just like our name, Evolution Real Estate, evolution. I don't know.
Yep.
Evolution of times. It's just kind of tracking it and seeing it's always changing. So
Yep.
it's not necessarily always a bad thing. We have to have an abundant mindset, and opportunities are out there. You just got to find them and realize them and keep moving forward. But
And as we know,
what
our
else do you have to share?
industry's
Yeah,
it's all cyclical, right? So like
it
we're
is.
going up
It is.
now and it'll come back. So everything kind of
Yeah.
just moves. So
Yeah.
anything else to add?
No, I think that's pretty much what our discussion and what we've been talking about, what's been going on, kind of seeing what's going on in the market through May and of 2022. And it's always fun to share. It's always fun to do this with you, and I appreciate it. And always appreciate your compliments about my good looks, even though
Oh
it's not
yeah, well
true. But
that's easy. That part's easy.
sucker.
Yeah. Oh, well, thank you everyone for listening and watching the Evolution Real Estate Podcast, where the evolution never stops. Good job, Scott. Woo!